So it's always a pleasure to share Quantum's views with you. And I'm going to start by asking a very pertinent question. Should private medical insurance come with its own health warning? Which sounds strange, doesn't it? But when you think that most employers, when they set up their medical insurance scheme for the first time, they look for the best possible scheme they can offer their members. Medical inflation's currently running at between 10 and 13%. Then you've got claims performance on top of that. So we're typically seeing throughout last year increases in premium of around 20 to 35%. Before we answer the question around should it come with a health warning, we'll leave that, we'll defer that and see whether my presentation changes your views. Now, I haven't gone mad. We are still going to talk about private medical insurance, but I want you to bear with me and think about this particular illustration, because I think it really does illustrate the private medical insurance market really well. If you imagine the angry mob there as the employees and the grizzly bear as the private medical insurance provider, the angry mob, we're seeing currently employee participation totaling a record 4.7 million employees within private medical insurance. And that rises to a staggering 14 million if you include dependents and employees participating in health cash plans. Now, with record numbers of employees, you then see record claims. And the PMI providers are currently paying out £3.57 billion worth of claims. It's phenomenal. So what's driving this? Well, our beloved NHS is clearly suffering from years of underfunding. But there's been a change, there's been a big change. And that big change comes from employers. Once upon a time, private medical insurance was a nice to have. Now, strategically, it's a necessity. And the reason it's become a necessity is because employees are demanding their employers protect the employee and their families. They're not asking, they're demanding. And for those employers that want to retain and recruit the best, they have to deliver it in order to get those people. Because I've seen people who have been offered more money, but not this benefit. This has become the number one benefit in terms of employee benefits. Don't get me wrong, pensions is right up there, but this has gone from nowhere to the top. People want protection. So, what happens when it goes badly wrong? Well, as you can see from this example, and this is a real example, this is a client. Now, I should add that the scheme has been in existence for a number of years, but Quantum have only had this client for a year. Okay, I'd just like to add that point. This was an employer that said, we need the best healthcare scheme for our members. And that's what they did. There's no protection in this scheme from an employer point of view. And I often liken private medical insurance at the very top end in terms of costing to a DB scheme, because the employees know what the benefits are, but the employer doesn't know what the long-term cost is going to be. It needs deep pockets for schemes like this. Now, as you can see, there's 109 employees participating in this scheme. This scheme, you could say, was a bit unfortunate because it had 5 or 6 oncology claims. It had a cardio claim, all 6 figures. And they accrued over a few years. So in this example, you've got the claims that were expected being exceeded by over £500,000. Now that's not good. And if you go back to the scenario I said before about the bear and the angry mob, the bear's not happy. The bear will look to get its loss back. So how does it do that? Well, it'll increase the annual premium. That's the first thing it will do. And that premium is increased by 92, 93% straight off. Now, we as consultants warn the insurer that if you increase the premium too much, the scheme will become unviable. Let me explain. We told the insurer before they put the premium up, and by the way, that premium that I showed you was after negotiation. That was the best premium we could secure. They started much higher than that. The membership dropped to 56. So the cost per head from the employer's point of view went from £4,600 odd pounds to a staggering £17,286. It was an incredible increase in cost per head. The angry mob is now very disgruntled. And the reason they're disgruntled is because the P11D rate, the rate that it costs in tax to provide that benefit to the employee. So you've now got a scenario where the employer is trying to placate the employees and the insurer because the insurer wants to recoup money. This scheme is important in terms of maintaining it because the ongoing claims, the high claims, continue. They still have treatment plans that need to be met. But I tested personally for this client whether I could buy individual cover through the same insurer on a like-for-like basis, more or less in terms of the group scheme benefits, and I could buy it cheaper than they could provide it. So what that tells us as consultants is that this scheme is no longer viable, ongoing. And in fact, this particular employer, where private medical insurance is really important to that sector, is now having problems in recruiting employees from other places because people are just looking at the cost of providing the benefit and it's too much. So we, Carl and I, are actually working on designing a structure with the current provider because this scheme is no longer tenable in the marketplace either. The market wouldn't touch this. And it's an all or nothing scenario. I can't leave the claims behind and move all the good healthy lives off. But somehow I need to attract all the healthy lives back into the scheme to make it more of a viable scheme. So that's the picture where we are. So my message to everyone is when you have a healthcare scheme, don't be afraid to set expectation to your employees because otherwise you'll find you've got a problem with your employees and the healthcare provider, the mob and the bear. So what can you do to protect your business? It's really important. Point number 2, the structure of your benefit must be affordable and sustainable. I really can't emphasize that enough because you don't want to be in a position like our client. Healthcare has become really flexible in terms of the benefit structures that you can choose. You can build in protection now. And for example, most new schemes want to apply what's called MHD, medical history disregarded, which basically means when you set up a new scheme, you're basically saying to everyone, no matter what's wrong with you, if it flares up, it becomes a problem, we'll cover it. And that's why you get the big claims. If you look at full medical underwriting, businesses don't like that because they feel it's a downgrade. Their employees can't then choose everything they need to be covered. Well, it's protecting the business from extortionate annual premiums going forward. Or you can choose a halfway house and it's called a moratorium. There is another way of doing it. And I often see questions asked about, well, Should we apply an excess? You know, that's not very good, is it? It's a tax benefit. In the UK, employees are very used to paying excess. Make it a viable one. Make it so that the employees see the worth of what they've got. And that will help you achieve that. For those schemes that are or have an annual premium in the region of £200,000 to £250,000 per annum, they should seriously be thinking about using what's known as a healthcare trust. Healthcare trusts are extremely flexible. They offer more protection. You can get aggregate stop loss, you can get specific stop loss. And one of the good things about healthcare trusts these days is that businesses themselves don't have to act as trustees, and therefore the duties are not yours. There's third-party trustees. There's even schemes that have been set up with certain providers that actually look like a fully insured scheme, but they're not. And when you go into a positive position, so you underperforming claims, which is good news, any profits that are normally lost to the provider in the same way as they absorb the losses, you retain within the trust. And as I said, healthcare trusts don't suffer IPT on the non-insured part of the benefit. So very attractive, often dismissed because people like me in the marketplace don't understand them, and therefore if they don't understand them, you're not going to understand them because you've got no one to explain it to you. So just before I hand over to Carl, if I go back to that original question, should healthcare come with a warning? Perhaps we can have a quick show of hands. Does anybody agree with me that it should? Yeah? I think it should. It really should. Too many companies, because of poor advice, I think, personally, are not awake to the fact that these are costly exercises and you have to have deep pockets if you want the top range benefits. But you don't need necessarily the top range benefits unless your business sector demands it. With that, I'm going to hand over to Carl because he's going to show you other ways of reducing premiums. Thank you for listening.
So a robust early intervention service supports your employees but can reduce business costs, including healthcare insurance. It's quite a strong statement, but it's actually true. What I'm going to talk about is early intervention. So I think it's fair to say, and you probably know this, employers have an obligation of duty of care towards their employees, and more employers are looking for health and wellbeing solutions. Early intervention services can dovetail and complement any occupational health you already have in place and support health and wellbeing in the workplace. Early intervention does speed up the process, makes things more accessible when addressing an issue, and there's less waiting time. As Graham has previously said, on the NHS, we understand the strains they're under. The idea of early intervention is to support and manage absence and prevent claim. So the idea being that if they're getting the support and being routed through to the relevant service they need to help manage a situation, it stops it then leading on into sort of claims against the policy and things like that. So what that does, it's win-win all round really. So the employer benefits because it stops the premiums going up significantly because they're not claiming. It means that the employee has been supported, and again, it's a tick in the box for the employer, obviously with their duty of care towards their employee. And the employee is back to work quicker. In addition to that, it obviously reduces costs in sick pay and the resource hours that you lose through absence. A really good thing as well is that if you've got group income protection, a lot of these providers offer these early intervention services at no additional cost. that's kind of quite a brief thing on early intervention, but I hope you can kind of see how it links to private medical insurance and the cost containment thing around that with the support services to prevent claims. Is there any questions on anything that Graham or I have covered off? If not, we'll be around for a little bit after. Oh, sorry.
Yeah, good morning. In your earlier example, you said that an individual could get a better premium than a corporate scheme. So why aren't more, you've still got the P11D effect, but why aren't more people just saying, okay,
It's a good point.
We'll give you, part of the deal is we'll pay your pension policy of, your medical health insurance of £4,000 rather than 17 grand, and do it that way rather than going through a scheme thing.
It's a good point. Let me clarify the point. You could only buy on an individual basis a cheaper policy because that particular group policy was no longer viable. Typically, you should not be able to buy individual cover on a like-for-like basis where the individual policy will be cheaper than the group. The group will always be cheaper and provide greater benefits unless it fouls like that one.